All right. Welcome, everybody, to the show. Tonight, we're going to talk about the markets, the global markets, what's going on, what's happening with strategy and portfolios. And I'm open to all of your questions. My name is Andrew Stotz, and I'm here at my home in Bangkok, Thailand. In fact, near Sok, BTS, in my home office. And I'll be talking a little bit about the strategies that I have with InvestX, and also talking about global markets and what's going on and what I'm seeing. I'll summarize a couple quick things before I get started. The first thing is that the market right now seems to expect a soft landing in the US. And I'd say the one area where I am differ than that is that I think that we are in for a reversal of Fed policy, and the Fed starting to reduce interest rates very quickly. And that will happen in the next couple of months, as I expect a recessionary environment. Now, when recession comes, normally the market doesn't do very well. So it's not a good sign for the market. However, what we have to see is that the Fed ends up pumping money into the US market. It could turn out to be very positive for the market. So that is one of the many things that we're going to talk about tonight. I just wanted to highlight that I love to get your questions. So feel free to send any question into the comments on this video, and I'll do my best to answer it. If you want to type your questions in Thai, feel free to do that, and I'll do my best to read them. So the first question that I see tonight, and I'm gonna go in and out of the presentation. The first question is there a recession coming in the US? And my answer to that is yes. I'll show you a little bit of that, but basically you have an extremely high interest rate compared to the past. You have an inversion of the yield curve. You have peaking unemployment that's very low, which happens every time before a recession. And I think that you have full employment, basically. So there's some of the reasons why I think that the US is going to go into recession. Now, that's not an easy time, but of course, if the Fed reduces interest rates, it could drive the markets. So I always think about having a diversified portfolio. Over the last year or so, the way I've looked at the markets is that I'm not going to get too aggressive. Why am I not going to get too aggressive? Because I am worried that there's downside. There's significant downside these days. And remember, we came into this whole crisis over the last couple of years with a very expensive stock market. So it's hard to see that we are going to be in a situation where the stock market's going to go up massively. And that's the reason why I feel like I've felt like there's more downside than upside in the market over the last couple of years. So I'll show you a little bit about my strategy and my portfolio. And in that, I'll give you some idea about what I'm doing. So again, I'm going to go into the presentation. I'm going to share my screen and bring up my presentation. And I'm going to talk about our global asset strategies. And remember, if you've got any questions, you can ask me in the chat and let me know. So my strategies are global, and they're long-term, and they're diversified. This is kind of the core foundation of what I'm trying to do with my investment strategies. So I'd like to just take a moment to kind of remember, why are we here? We are here to build wealth over the long term. That's the goal. And we know that some foundational principles are that you should be diversified. With our strategies, you can build a globally diversified portfolio that's not only globally diversified, but also diversified across asset classes of stocks, bonds, commodities, and gold. And of course, another core principle is to contribute regularly and stay invested. So we're going to talk about the idea of trying to build some financial independence. We're going to go through the performance of the different portfolios. It's been a tough month or so that we've had with the portfolios, but I look at it from a long-term perspective. And so I'm not particularly worried about it. So almost all of what I do and talk about at InvestX is based upon my book, How to Start Building Your Wealth Investing in the Stock Market. It's available in English and Thai in Thailand. And also I have an online course about it. In the book, I talk about 12 steps to financial independence. And I'd like to just reiterate these because this is a core foundation of what I'm teaching. First, number one, create a plan and follow it. Number two, keep investing simple. Number three, start early because time really is money. And get real about stock market returns is number four. Do it yourself. Number five, avoid mistakes when you're young. Number seven is build wealth through savings. Number eight is keep financial costs low. Number nine is diversify to reduce risk. Number 10 is own both stocks and bonds. And number 11 is trade infrequently. And number 12 is stay invested and watch it grow. So what is financial independence? Well, as children, we start off completely financially dependent. And from there, we start climbing the ladder towards financial independence. We have different opportunities and different goals, but most everybody would like to be financially independent. I'm sure you would like to be, right? That's the key. In fact, I just had someone new to investing contact me on my Instagram today, and I asked what is their goal, and they said, I want passive income. Now, if you've heard about the concept of passive income, it sounds very exciting, but I'm going to tell you that passive income is not as exciting as it seems. So let's look at 6 levels of financial independence. First is complete dependence. Children too young to work, or elderly without a savings or retirement, or unemployed people without savings and Social Security. It's tough. In that case, you rely on others to support you to survive. Number 2 is financially dependent. You're making some money from work, maybe as a young person, but still relying on others like parents to cover your lifestyle costs, education, and all that. And you still don't make enough money to save. And then there's number 3, some financial independence. You can support yourself through work, but your boss or customers still dictate your life. And you have savings, which can cover unseen problems. And you start investing. Number 4 is being financially independent. You make enough money to care for yourself and your family over your lifetime. You have enough assets to say no to things that you don't want to do, and you feel confident that you are in charge of your time. Of course, number 5 is where we all want to be, which is rich, where your assets are making enough money to finance a fancy lifestyle for you and your family for longer than your lifetime. And only a rare event could lead you to lose your financial independence. And of course, there's number 6, more money than God, rich. Giving away money to causes you believe in is the only way your investments won't compound faster than you can spend. And my strategies, of course, aren't going to make you more money than God rich, but we're trying to help. So my first message I want to talk about is that you won't get rich in the stock market. A lot of people go into the stock market thinking they're going to create their wealth. But I'd like to just for a moment talk about this because I think it's such an important point. So I'm just going to talk directly to you in the screen. And I just want to highlight that biggest mistake I see people make is that they think they're going to get rich in the stock market. And so they're making big bets. But I really want to encourage you to separate the concept of risk and return. The idea being that we think about risks, we think about return, but those are 2 separate things that we're trying to combine to build a safe portfolio. The second thing that I want you to think about is separating creating wealth from growing wealth. how do we create wealth? We create wealth through our business, and we create wealth through our salary. For some people, they have a business and they're making money every single month, and that business is making profit. They're earning a dividend. It's fantastic. But for most people, they're earning a salary. And in order for you to be able to create wealth, what you want to be able to do is you want to be able to get a salary much higher than what your costs of living are. If you can manage that to either get a higher salary or keep your costs down, let's say that your salary is 100,000 and your costs are 40,000. That's 60,000 of wealth that you've created in that month. And so many people create that wealth, they put it in the bank. It doesn't grow much, but they feel safe. But eventually they go to the stock market to grow their wealth. And that's why I really wanted to highlight the idea of the difference between creating and growing wealth. Let's continue on with what I was saying, and that is I want you to view the stock market as a place to grow and protect your wealth. And you create wealth, again, through your business or your salary. And we've created our strategies to help you become financially independent. If you're already financially independent or rich, our strategies can help you stay there by protecting wealth. Now, our goal is to deliver steady returns over the long run. This is a picture of our 3 strategies. It has been a bit of a tough start, but remember, it is a very short period of time. When you're thinking about managing your money, you really want to be thinking about decades. So GIPS is low risk, and GAZE is medium risk, and GAS is high risk. They don't always act that way, and they may be much more volatile. But gas is an example. The green line is down quite a bit because it's been a bit of a rough ride for the markets. So gas hasn't performed well year to date, but higher risk means a higher likelihood of deviations on the downside and potentially on the upside. So we create our strategies for decades, and even decades are not really long term. There's me when I was a little baby, and there's me when I came to Thailand, and there's me when I'm 100. Our aim is to create strategies that perform over many decades. Now, I want to introduce our FEMR framework because this is a key to how we think. And it's one of the reasons why you'll find that I don't get overly emotional about the markets. So what is your investment framework? Our investment strategies for ETFs and stocks and funds comes from our FEMR framework. We backtest and we optimize the strategy for the factors that have worked best in each market. We do all of our research in-house. That's myself and one of my business partners, Sorensuk. And we don't rely on other people's research. We might, of course, get ideas from others, but we then test those ideas in our FEMR framework. Now, the benefit of an investment framework is that it forces disciplines when emotions run high. You know, that feeling of being really, really stressed about the market. Emotions from wild market events can cause you to make rash and costly decisions. To avoid this, stick to a framework. What is your framework? Think about your framework. FEMR is the framework I've developed. Our framework relies on data and structure, not just a feeling or opinion. So what I want to start off with is this diagram. And at the top of the diagram, it's management. Management is responsible for producing earnings. At the bottom is investors who set the price that the assets trade at. And there are 4 elements to our FEMR framework. The first element is fundamentals. We look for strong profitability because that shows that a company is managed well. And we prefer high or rising profitability, of course. The next is valuation, which shows how the market perceives the asset or the stock. And we prefer good fundamentals at relatively cheap valuations. Next, number 3 is momentum, where we try to avoid value traps by looking for positive price and earnings momentum. And at times, we have to remember that low momentum signals an out of favor opportunity that may be attractive. And then there's risk. We prefer low business and price risk. And not every asset is going to fly, right? Sometimes some assets will just provide stable returns and strong dividends. So now let's go through our strategies and get a picture. But before we do, I just want to talk to you briefly. Remember, ask any question that you have, either about the strategy, about global markets. I did see a question, which I'm going to go to right now, and that is, what do you think about U.S. banks versus Thai banks? Well, the first thing is I think that U.S. banks, the smaller and mid-sized banks, are under a lot of pressure. And the Fed has tried to relieve that pressure by helping the banks raise cash. But I think there's a lot of pressure in the regional banks. One of the reasons for that is because you've got all kinds of construction and real estate projects going on in America. And those projects are almost all financed by the regional banks, not by the big, global banks like JP Morgan. They're only financing huge real estate projects. And those real estate projects, I would argue, are really under a lot of pressure, particularly in high-rise buildings where in America, people just haven't really gone back to work. They're working from home. So I would say that mid-sized U.S. banks still are facing some trouble. Now, the question asks, what about Thai banks? And my answer to that is that, first of all, I've been amazed that Thai banks have done so well through the crisis and through the lockdown. I would have thought that they would have suffered more, but they were definitely on the ball in working with their clients. So overall, I have to say that Thai banks have done pretty well coming through this past crisis. Now it's a question of what's going to happen if we face a recession in America, and how will that impact Thai companies. It will be difficult for companies in Thailand in a recessionary environment, and ultimately Thai banks will suffer a bit. But I would say that they're through the worst right now for Thai banks. So I think Thai banks are in pretty good shape, and I don't see them as overly expensive. Probably interesting to build a position in one or two of them, but that gives you some idea. And keep asking any questions if you've got any. That was a question about U.S. versus Thai banks. Now I'm going to go back to my presentation, and I'm going to talk about the performance a little bit. And here you can see that since inception, the global inflation plus strategy was 4.4% below a 40% equity, 60% bond portfolio. And that's as of May 31st, 2023. So it hasn't been a great time for the strategy, but the strategy is very low volatility, right? It's experienced much less volatility. And I would expect that over time, it's going to start to rise, but mainly also be a slow and steady rise. In May of 2023, the strategy was 1.1% above the 40-60 portfolio, which was down about 1.6. So if you look at monthly performance, you're going to see a lot of ups and downs. But again, I look at it over a long period of time. Now, except for tips, bonds held up well. And the World Equity Fund outperformed the MSCI All Country World Index. Our 5% weighting in energy got hit really hard. I mean, in fact, that is a big reason why we've had some pain in the portfolio. Luckily, it was only 5% of the portfolio. All right, it's time to announce our new allocations. And here you can see that in this strategy, we keep bonds at 65%, equity at 25%, and gold at 10%. So we've made some slight changes. We've moved 5% to World Infotech from World Energy, and we moved 5% to tips from the money market. That gives you a picture of the changes that we've made. Now let's look at the global asset enhancing strategy. That strategy since inception was 3.6% below a 60-40 portfolio as of May 31st, 2023. So it's been a bit of a rough ride. In particular, we when markets are down, it's hard to perform. And here we can see that the gaze is basically 0.5% above the 60-40 portfolio in the month of May. So we did okay. Our 25% allocation to Japan outperformed significantly. And our 25% gold and developed Europe allocations were a drag on the May performance. So let's look at new allocations. In fact, we have no new allocations for this strategy. We're keeping it just the way it is. That's equity at 65% and gold at 25%. Now, remember, maximum equity is 85%. Also, what you're going to see is our exposure to the US is very low at 5%. Basically, I've been cautious, and my model, FVMR model, has got me cautious on the US. We keep the same target allocations as we had in our past revisions. Commodities and bonds are at minimum of 5% allocations. We've overweighted developed Europe and Japan within equity. So now let's look at the global alpha asset strategy, which was down 2.7. Now this is the highest risk one, so you're naturally going to have higher volatility. And here we can see since inception, the strategy was 12.7% below the 70-30 portfolio as of the 31st of May. So it's been a painful ride right now. The strategy was 1.4% below the 70-30, and our tilt to Europe small caps held up well, but our tilts to world healthcare, infrastructure, energy, and precious metals miners did poorly. And that's really our pain for this particular period of time. And now we'll announce our new allocations. And what you can see is that we're reducing equity to 68% from 78%, and we're exiting world energy, and we're increasing gold. We're taking a more defensive stance, keeping bonds at 13%, but raising allocations to defensive sectors like healthcare and infrastructure. We're adding 3% to infotech to capture more of its momentum, and we've reduced miners as gold has performed better. That gives you a picture of the changes that we've made. Now, let's look at a global outlook of what's going to be happening. Before we do that, I'm going to come back to talk to you briefly and take a question about China. I know some people have asked about China and the Chinese market, and I would say, from my perspective, I think the Chinese market's going to have a hard time going forward. And why? Because it appears that the U.S. is on a war path with China. They want confrontation, and the U.S. is at the top of the hill, and it seems like they're trying to hit China right now. And so what happens is that prevents a lot of U.S. money from flowing into China. And the result of that is it's hard to see that the Chinese market can really do particularly well when I think there's risks that fund managers in the U.S. will find it hard to allocate to China. I'm just standing up because I've been sitting all day. So that's my fear, is that Chinese market's just not going to perform that well. And I hope that gives a little bit of an idea of an answer to that question. Now I'm going to go back to the strategy, and let's look at what's going on in the space of equity. The 3-month government bond yield has risen to 5.3 from 2.5 a year ago. And central banks have battled inflation while trying to avoid a severe recession or banking crisis. Expect higher rates, though, at a slower pace, as central banks haven't yet got inflation down to target levels. Now, if we don't get a spike in oil, this is critical, right? Oil is the key. If oil is crashing, inflation is going to be coming down. If oil is rising, inflation is going to rise. But ultimately, I see by the end of this year, 2023, we could see inflation down to about 3 to 4%. Now, given this backdrop of sticky inflation and higher rates, we have a moderate equity allocation in our strategies. Still, in the long run, equity is the best hedge against inflation, as companies must adapt to survive. Now, after the pause in June, the market expects another rate hike by the Fed in July. There's a 72% probability for a 0.25 25 basis points hike at the next FOMC meeting. Now, the expected rate curve has shifted up after the May meeting. You can see the dotted line was May 8th, and now we can see June 16th, the red line. So actually, expectations have risen. But ultimately, that is a picture of a soft landing. That is what people expect from the Fed and from the US market. So besides battling inflation and avoiding recession, the Fed now tries to avoid a banking crisis. The only thing the Fed seems willing to sacrifice are US jobs. Now, here's part of the reason why I mentioned right at the beginning that I think we're heading into a recession. Why is that? Well, yield curve inversion has just continued to collapse. And all recessions in the US since 1968 were preceded by an inverted yield curve. The average time from inversion until the recession started was about 1 year. So about this month. This is one of the major reasons why I see that we're going to be facing some difficult times. And that's because short-term interest rates are so high that it's slowing down the economy. And that's exactly what the Fed said they want to do. So for the past year, we've said that we think the course will eventually be reversed and the Fed will have to cut. I still think that the central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And I do think that they'll break something. We already saw Silicon Valley Bank and the pressures on the banking sector. We're also seeing the attack on the real estate sector, which is also another one that is under a lot of pressure in the US. And so we haven't seen much pressure on the high yield bond market, but I expect that that can come. Now, European stocks is one place where we've had an overweight position, and they're relatively cheap. As you can see, they didn't have nearly the bubble of the US market. And here we can see that PMI signals expansion in Europe, though it's a bit up and down recently, and we do have a little bit coming down, but above that line, above 50%, tells us there's expansion. If the PMI is above 50, it means expansion, and below 50, contraction. And improved consumer confidence in PMI add to the attractiveness of the developed Europe equity. And we've got a 25% target allocation in the Gaze portfolio. Japanese companies have been hoarding cash over the past decades. This is actually pretty incredible. What you can see is they're now sitting on $2.2 trillion in cash. That's at Japanese non-financial companies like non-banks. That's an equivalent of 44% of GDP in Japan. Now, higher inflation in Japan means the private sector is pushed to invest. Higher inflation can lead to private investment and higher consumer spending, not to lose purchasing power. Now, we've got a 25% target allocation in Gaze, and that is a heavy allocation and a heavy bet on Japan. Of course, a risk is that if that goes wrong, it is going to hurt us. But for right now, we're riding with that at least for the next 3 months. And in the healthcare space, the demand for care and drugs is independent of economic conditions or cycles. Face it, if someone in your family gets sick, you want to take them to the best place. Medical procedures that were delayed due to COVID are now driving demand also. So we've raised our allocation to world healthcare to 17% from 8% in the gas portfolio. Infrastructure is defensive, and we've raised our target allocation to 17% from 8% also in the gas portfolio, benefiting from government's green energy, energy security, and other infrastructure spending. Typically, predictable cash flows and the ability to push through cost increases from inflation are what we like about the sector. Now, there's strong momentum in the infotech stocks, and we've added in 5% in GIPS and 3% in gas. Much of the year-to-date recovery in the U.S. market and others has been driven by tech. We think the positive momentum by AI is that sentiment will continue. Of course, the recession risk remains. Now, before I continue on, I'll just come back to talk a little bit more about that. But I would argue that right now, I want to talk a little bit about AI because that's a major topic. Obviously, if you can own companies that have AI in them, fantastic. But what AI has the risk of doing is really hurting the middle class, particularly in America. And the middle class, some of them will get AI and see the benefits and they'll apply it, but other people will fade out and they'll have a harder time. So I do think that that's a problem with AI. So I see that Suti Chai has asked a question. Let's see that question. Hold on. I'll do my best to try to answer it. But so พอดีภาษาอังกฤษผม ไม่เคยดีครับ Okay, no problem. And if you want to ask a question, you can ask a question in Thai. Feel free to type a question in Thai. My Thai reading is kind of slow, but I can get it. So let's take some questions. If you've got any questions, now's a good time to ask them. Okay, let's see. Peter Pan says, what do you see in the price of gold moving in the next 3 months? Well, I think that in the next 3 months, we're likely to see the U.S. go into recession. We're possibly going to see the U.S. market take a hit, and then eventually the Fed comes in. So I would say I'm looking for stability in gold right now and a little bit of a chance to outperform going into a recessionary period. So I would say I am kind of neutral to positive on gold. But remember that one of the reasons, the main reason why we have gold in the portfolio is that it's not highly correlated with equity. So if equity markets go down, gold tends to not go down nearly as much. Good question. All right. If you've got other questions, feel free to ask. Now is a good time. I'm going to take a little sip of water. Somebody noticed my Warren Buffett behind me. You see him on the little car. One of my friends gave me that. There's my Warren Buffett car. A friend of mine went to Buffett's annual get together and annual meeting, and he brought that back for me, which was very nice. All right. Feel free to ask any questions that you have. I'm going to go back into the presentation now and look at gold. As say, when I look at gold right now, what I just see is stability. I would say that stability is what I'm looking for with gold for the overall portfolio if the U.S. was to fall. And that's part of the reason why I have gold in the portfolio. So if the stock market rises a lot, gold's not going to rise much with that. So it's a defensive position. So we keep a relatively high gold allocation in our strategies, which also serves as insurance in times of uncertainty. In general, gold protects value in times of uncertainty and market downturns. So that's where I'm really using the gold in the portfolio. So what are some of the risks that we face? First is that inflation accelerates. If inflation starts to pick up, then central banks, aggressive rate hikes and QT could crash the market. And poor EU and Japan markets would hit the gaze portfolio because we do have a heavy weighting there. And a better overall sentiment could lead to underperformance of defensive sectors, which we're in right now. Also, if inflation re-accelerates, we could miss out on rising commodity prices. We've basically been pretty good with commodities. We were in commodities very early, about a year and a half ago. We got out a little bit late, but overall, I feel okay about our commodity position in the past. Our high gold allocation could get hit by higher rates or improved market sentiment. Let's say the market runs, gold doesn't run as much. Now, before we get into any further Q&A, make sure you ask any Q&A that you have. Just remember, I have the Valuation Masterclass Bootcamp number 10 that starts on July 3rd. And our limited super early bird price is still available. And with the InnovestX coupon, you can get another $100 off. So just get extra $100 off on any price point until June 23rd. You can save up to $800. This is the coupon code InnovestX. Just go to valuationmasterclass.com/bootcamp or scan the QR code. So now I'll take any questions that we may have. And I did see a question about Vietnam. So let's go and talk briefly about Vietnam. Now, in my FVMR strategy, we look at Vietnam as well as other countries around the region. Vietnam has yet to be attractive relative to other countries. And that's part of the reason why I haven't gotten into the Vietnam portfolio. And so for right now, for me, Vietnam doesn't look that interesting. Now, I also got a question about India. We had previously had a pretty heavy weighting in India, and we were riding the Indian market. But now we brought that weighting down as the market is pretty expensive. So that is where we're at as far as, so basically I explained underweight China, underweight Vietnam, and underweight India. Those are our plays right now. We're not in those at this point. All right. So somebody asked, what will the Fed do? And the point is that I believe almost every single time that the Fed raised interest rates so fast, very fast, they always do it fast when it comes time to try to slow down the economy. They raise rates as fast as they can, and they slow down the economy. And then there comes a point, this is over the last few decades, there comes a point where they rush to bring down interest rates. And I think that's what's going to happen in the US. Now, the good news for Thailand is that Thailand was never a bubble like America was a bubble for a period of time. The bad news, of course, in Thailand is we don't have a lot of tech companies, so we can't get the benefit of some of the wave that's happening in tech. We have a tight labor market here in Thailand, just like they're facing in America, where unemployment is almost at its all-time low. And when unemployment is at an all-time low, that's usually a sign that you're at or near the peak of the market, because you now are getting everything you can out of that economy with peak unemployment, that there's like no place for things to go except down. So those are some of the questions. If you have other questions, make sure to put them in the chat. And before I go on to any other questions, I'm going to go back to my presentation and just highlight that the InnovestX app can be your tool for all of your transactions. But if you're interested in these strategies, you just go in and look for the Guru Reports. And once you're in there, then you can click and learn more about this and other Guru Reports. This is a cooperation that we've done with InnovestX, and we've been enjoying that relationship and enjoying bringing these strategies to you. Ultimately, our objective is to have strategies that are well diversified, they're global, so you're getting exposure outside of Thailand, and also that they're long-term, that we're thinking about the long-term and we're following a structure. And that's really what we're doing. So I just want to say thanks to everybody for joining this session. And again, make sure that you play around with the app and see how you can execute the portfolio. Talk to an advisor, talk to your people that you're working with at InnovestX, and they'll advise you and give you great ideas about how to invest. But for all of you that are invested into my strategies or who are looking at them, I just want to say, thank you for taking that time and, going through and putting your money into the strategies. I'll continue to do my best. Peter Pan says, if U.S. recession in the near future is a soft landing, will the U.S. tech stocks continue performing well? I would say yes. If we have a soft landing, tech firms are just on a run, and all of the noise about AI and all that probably keeps them running. Somebody asked me recently, is a tech stock situation like the dot-com period when they were really inflated? But the difference in the dot-com period, the tech companies weren't making any profit. But US tech companies in particular are super profitable. So I would probably bet in favor of the tech companies if we have a soft landing. If we have a hard landing, I think that it's better to be owning defensive sectors like utilities or consumer staples, as an example, maybe infrastructure, some of the ones that you've seen. So that gives you some picture that I see on US tech stocks. All right, next question is, recently the meeting between US and China, do you think any impact to the US-China stock market till this year end? I'm pretty negative on the Chinese stock market, only because when I look at American politics, I can see that both Democrats and Republicans seem to be really aggressive against China. And one of my concerns is that the index providers like MSCI have slowly added China to the index. Now China represents 40% of the emerging market index, which basically means that a fund manager in the US has to pick Chinese stocks, and they have to build exposure to the Chinese market. And the fact is that I think that the US politicians, the US government, maybe even US people will try to cut off the constituent part, or the part of the index that's China, and reduce China's role in the index so that fund managers back in America don't have to invest in China. In addition, I think there's definitely a risk that the US government puts some restrictions on putting money into China. And that's the reason why I'm just hesitant on China, number one. The second reason is, I think I pronounce your name. I'm trying to read your name in Thai. It looks like it says Pichet. I don't know if that's right, but that's my pronunciation. But the thing that I see going on with regards to China is, it seems to me like I had two people from China come to visit me at my home. They just flew in from China. They have some business going on in Thailand. So they came to see me and we talked about business. And I asked them what's going on in China. And it was interesting because what they were talking about is it's like Chinese people lost some of their entrepreneurial spirit. And when they did the lockdown, it really hurt the sentiment. And so and then also remember, before the lockdown happened, what we were seeing in China was that they were doing like rolling blackouts. They were shutting down some parts of the industries like steel. So I had a friend of mine in Thailand that was importing Chinese steel, and he was having a hard time finding it. I know that we had some hard time getting, for one of the businesses that I invest in, a coffee business, we import some machines from China, and we were facing some delays at getting the machines because they were slowed down from the steel and all that. So yeah, so I'm kind of, let's say, negative to neutral on China right now. Wasupon says, really appreciate what you've shared with us. It's my pleasure, and happy to keep sharing, and feel free to keep asking any questions over time. And Pichet said, yes, I got that name right. Yeah, there you go, Pichet. So my Thai reading is a little bit slow and not always correct. I studied Thai 30 years ago when I first moved to Thailand in 1992. And I was teaching at Mahavidyalai Hokan Ka Thai, and I was teaching finance. And then each morning I would go to AUA, which was really the only place to learn Thai in Thailand at the time. And so I went to learn at AUA in 1992 for the first 6 months I was in Thailand. So I was learning reading, writing. I had a really tough Thai teacher at that time, and we had like 4 hours of class. Then I went back to the university and worked. And then after that, I had homework. So it was tough then. But I don't read or write very much these days. So yeah, it's good to practice. All right. Well, I think that wraps up tonight's session. I want to thank everybody for attending and asking questions and sharing in this. I love to talk about what we're doing with the strategies, and I also want to thank InnovestX too, because they've given me this platform to share with you. And I see that Pichet says I graduated from Hawkon Katai Due. Yeah. In fact, I was the founding director of the English language BBA program at Mahawitilai Hawkon Katai. That was a long time ago, 30 years ago. All right. Well, to everybody online and InnovestX, I want to thank you for taking the time, spending the time. I know you're busy. Everybody's busy. I'm going to relax a little bit, but also remember to check out the app and see how you can execute and follow your dreams. Have a great evening, and I'll see you soon.
ถ้าคุณมีเงินเก็บ
แต่ไม่รู้จะเริ่มลงทุนยังไง
ขอแนะนำเลยฮะ InnovestX แอปการลงทุนที่เข้าใจคุณมี Intelligent Portfolio บริหารพอร์ตการลงทุนอัตโนมัติ
เดี๋ยวเราดูแลแทนคุณให้ครับ
นี่เจ๋งปะจะเลือกลงทุนตามเมกะเทรนด์โลกลงทุนเพื่อพิชิตเป้าหมายหรือลงทุนตามกูรูดัง
เริ่มลงทุนได้ง่ายขึ้นเยอะเลยอ่ะ
ถ้าคุณมีเวลาน้อยแต่ข้อมูลลงทุนเยอะเรามีเลขาส่วนตัวฮะระบบ Personalized Notification เตือนข่าวสำคัญ
โอกาสลงทุนมาแล้ว
ให้คุณปรับพอร์ตได้ทันการ
แค่นี้ก็สบายใจแล้ว
และถ้าคุณลงทุนหลายอย่างนู่นนี่นั่น
เลยต้องใช้หลายแอป
เปิดดูรัวขนาดนี้ระวังนิ้วหรอกนั่นไงถ้าอย่างนั้นเรารวมมาให้พี่น้องครับ InnovestX ครั้งแรกที่ลงทุนในสินทรัพย์ดิจิทัลหุ้นระดับโลกหรือสินทรัพย์ไหนๆก็มีครบพร้อมสรุปพอร์ตให้ได้ในแอปเดียวพร้อมไหมฮะออกเดินทางสู่อนาคตแห่งการลงทุนกันเลยไปวันนี้หลักทรัพย์ไทยพาณิชย์ได้เปลี่ยนเป็นหลักทรัพย์ InnovestX พร้อมพาคุณสู่การลงทุนแห่งอนาคตครบทุกจักรวาลการลงทุน InnovestX แอปที่เข้าใจการลงทุนเพื่อทุกคนโหลดเลยผู้ลงทุนควรทำความเข้าใจลักษณะสินค้าเงื่อนไขผลตอบแทนและความเสี่ยงก่อนตัดสินใจลงทุนการลงทุนในสินทรัพย์ดิจิทัลมีความเสี่ยงโปรดศึกษาและลงทุนให้เหมาะสมกับระดับความเสี่ยงที่ยอมรับได้